Welcome to chapter 2 of the NQ Futures Blueprint. How I'm going to be able to take you guys from a complete beginner trader all the way to a funded trader and getting your first payout and creating consistency with trading and treating it like the real business that it is. This is going to be a long video. This is the ICT, my strategy, how I view ICT, vocabulary crash course on how you can start to understand all the concepts we're going to be breaking down more in depth between chapters 3 and 5, starting to hop into strategy and all the things that you're going to need to understand. Do not skip this video. If you have not seen chapter 0 and chapter 1, go and watch that before you watch this. That is going to be very crucial to understand what we're going to be going into, setting the foundations to be able to fully understand what we're going to be talking about. We have, let's see here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 different concepts we're going to be covering. It's going to be a long one. Hold on. Make sure you write down and take notes on everything. Rewatch each section until you understand it fully. It's going to be great. Let's get straight into it. All right. The very first concept we're going to be going over is market structure. This is a very, very, very crucial part of your understanding of trading, how to really read the market, see what the story it is telling, and start to piece that together. So there are 3 main types of market structures, market conditions. We're going to go very in depth of how to actually see these on the charts. But first, let's look at this graph to start to have your basic understanding. So we have bullish, bearish, and consolidation / range, accumulation, all of the different names for that. So we're going to start from left and move right here. Bullish is very simple. It means that the market is moving in higher highs and higher lows, trending upbound to buy side. That is all it really is. There's no reason to overcomplicate these concepts. It is literally just what it is. Okay. So bullish market is moving in higher highs and higher lows and reclaiming highs over and over again. Okay. A bearish market is the exact opposite. It is when we are moving in lower highs and lower lows, claiming the left lows in the market. Okay. So that is bearish and bullish. Consolidation is basically the best way to put it, and I want you to ingrain this into your guys' head now, is consolidation is when you do not want to be trading, okay? So consolidation is when we think that structure could be created here, and then we completely invalidate structural points over and over again and never really make up our mind, okay? I put question marks here because that is when you should be deciding not to place any trades, to stay out of the market until you see an actual structural engineer start to step in from that consolidation range. From then, you can look for valid setups, okay? So those are our 3 main market structures. Take a screenshot of it, write down in your notes, whatever you need to do. So these are considered swing highs and swing lows inside of the market, okay? So this would be considered a swing high. This would be considered a swing low, swing high, swing low, swing high, swing low, swing high, swing low. Okay. That is how I want you guys to view this for now. Okay. Also, we're going to be going really quick into breakage structures and change of character. We're going to make it really simple on this graph first, and then we will move into the charts. So a breakage structure is simply when the trend continues. So from this higher high, also known as a swing high, pushing past here would be considered a break-in structure. We abbreviate that as BOS. Okay. Once again, we push past this area, making a higher high. This would be a break of structure because structure is continuing to break higher, creating new swing highs, new higher highs in the market. And then once again, right here, we have another break of structure. Okay. Now, what is a change in character? This is a lot more niche. Breakage structures are important to mark out and to keep in your back of your mind, but change of characters are going to tell you a lot stronger of a story. Okay, so say we are bullish here, and we create a higher high, and then all of a sudden, we start creating a different type of structure here. Okay, what is this type of structure going to do? Because you got to remember this as a trader, and it's very ignorant to not think this. it is completely premature to think that we're just going to continue in bullish structure or continue in bearish structure for all of market history, okay? That is not how we work. We will shift structure multiple times in a trading day, most likely, and you need to be able to realize when that is. Okay, so what is the early signs of a change in character, and then what is the actual change in character? So early signs is we are moving in higher highs and higher lows here, and we see the lower low get put in, or a higher low get put in, and then we fail to make a higher high here. That is the first sign of a potential market shift. Now, what is the actual change in character? If we are moving in a bullish market, which is higher highs and higher lows, what we need to see to have a full change in character is for the most recent higher low to get closed past, for price to move past that area and to see us have strong delivery to creating a new structure, which in this case would be bearish, of lower highs and lower lows. So this right here would be considered our change in character. We mark that out as CHOCH. And it is because this is the most recent higher low. Okay. And from there, we can expect for market to possibly shift based off of narrative, based off of a possible PD array or point of interest that we reached up here. All these different things come together to make up our changing character, changing market structure. And also, we talked about this in the last chapter, so make sure you watch that before you watch this, that you have to keep in your mind about timeframes. Timeframes are very important. They are basically what brings in the full encompassment of price. So you can have, say, here, let's take a screenshot of this. If you didn't, we're going to get rid of it real quick. So let's say this is the 4-hour time frame in a bullish structure, okay? Creating us our higher highs and higher lows over and over again. If we zoom down to, say, just this part of this 4-hour time frame here, what would that look like on something, say, the 15-minute time frame? Because we're not going to look the same when we go down on different time frames and see more noise. So what this could possibly look like on a 15-minute time frame is a bullish market structure, a shift, and we create bearish market structure before shifting again. Okay? So the lower the time frame, the higher the time frame you go, you can see different structures playing in at different levels of the market, pulling together a full story. Okay, so let's break this down real quick. If this is the overall 4-hour structure, which is obviously bullish here, how can we identify this 15-minute when it is going to be changing? Okay, well, let's look at higher highs, higher lows, breaks of structure, and change in characters. So we are moving in higher highs and higher lows here. And then what we see is the most recent higher low that gets closed past. That is our change in character. Okay. So we can possibly look to see if price is going to create new structure on the 15-minute from this area. And then what we do is we start creating lower highs and lower lows until, once again, we see a change in character. Instead of it being the most recent higher low, it'll be the most recent lower high because it is from bearish market. And then from there, we can see us switch back to a bullish structure, creating higher highs and higher lows in line with this right here. Okay. So that is how you can use time frames to bring together a full encompassment of bullish and bearish structure. So let's move on to the next concept. Right after, well, let's do this first because this is very important. Let's give some examples on the chart of our structure that we are going to be looking at. Okay. So this is a very good example. This is a very easy way to use this. You should go on your trading view chart with all these concepts and practice it a lot. Okay. So we're just going to use this little area of price right here. What we can see is that we are moving in higher highs and higher lows here. Okay. It doesn't always look this clean, okay? But you need to, like, so I kind of got confused with this at first. It's not going to be like the perfect exact same legs like this. Sometimes it can be a small little higher high, a small little lower low, a bigger higher low, and it can be different sizes and shapes. It doesn't all have to be the same. But tried and true, this is what it is. We have a high, a lower high, I mean, a higher high, sorry, a higher low. I mean, geez, higher high, higher low, higher high, higher low, and then a higher high. Now, what can we identify as our change in structure? Okay, is when we have this most recent higher low get pushed and close past, we can expect for the market to shift. And then from there, what do we see? We see a big dump. We have a lower high, a lower low, a lower high, a lower low, a lower high. Now, ooh, look at this. What is an early sign of a change in market structure is when we fail to put in a lower low when we are in a bearish market, okay? So we have the change in character here. Let me mark that out so y'all see it. Okay, we are putting in higher highs and higher lows, and then we see lower highs and lower lows here. And then what we see is market fails to be able to push lower, creating a lower low. So that can be the first sign of a change in character back bullish, but that's just an early sign. What we need to completely confirm that is to see a close past the most recent lower high. I get them so higher high, lower high, it's all like mixed up. So this would be our change in character back to a bullish market, okay? And that is just simply on this time frame. I hope this makes sense to give you guys your first little snippet of what it looks like. We will do one more thing really quick to show you guys an example of it on a lower time frame. So we're going to box out this area right here, okay? We're going to go to the hourly time frame. Actually, probably better do the 15 because that's what we did before. Okay, so we know on the 4-hour time frame that this is this one big structure right here, okay? Now, what we can see on the 15-minute is all these different structure shifts, okay? What happened? Did the wrong thing. We can see all these different structure shifts, okay? Y'all can start to identify them on your own as well, okay? But we see all these different structure shifts, and for structure to kick in here, that is different from on the 4-hour, on the 15-minute, because a pullback or a retracement on the 4-hour time frame to continue bullish level will have to switch structure on a lower time frame like the 15-minute. So that is it for market structure. Let's move on to the next concept. All right, the second concept we're going to go over is liquidity, the king of the market. Market structure and liquidity put together creates a beautiful harmony of being able to read price and predict its next moves. So liquidity, the way I like to explain it, is this money in the market, where money rests. So with liquidity, liquidity rests above highs and below lows. It is simple as that. Those points in the market either continue down or up for a reason, and that reason is money. When I look at the charts, I am seeing it in a perspective of orders, auctions, and massive amounts of money that are being poured in to push market in the direction they want to see it go. It is not at random. It is completely planned by the market makers, the banks, the institutional people, big money entering the market to fill at a certain area and exit at another certain area in price. Okay? So liquidity rests above highs and below lows. It's as simple as that. Some liquidity is more powerful than others. We will get into that also a little bit more in this episode, but right now we're just going to go over the basics of liquidity. Okay, so I have a few things marked out here to show you on a graph here, and then we'll move to the charts to show some examples. So we are in a bullish market here, moving in higher highs and higher lows. Okay, now, as we know from the last thing we just went over, it does not stay like that forever. One of the most common ways market structure will shift is through a liquidity sweep, okay? So what we see here is we pulled up, we see market take out the most previous higher high, and then we see a shift, okay? And then we have a buy side, well, okay, let me explain this before we get too far. There is buy side and sell side liquidity. Buy side liquidity rests at highs, okay? And sell side liquidity rests at lows. So we take out buy side liquidity here, seeing a shift in market structure. That simply just means that there was a lot of money, a lot of orders resting at this high, and that sellers wanted to step in at this area to see us shift structure and to fill their orders at the sell side liquidity. Okay, so we see bullish market, we see a liquidity sweep, sellers step in and take over the market. And then once we reach strong sell side liquidity where they are willing to take their orders off, buyers are able to step back in and we get to deliver to a new possible draw on liquidity, being buy side in this situation. Okay, so that is the simple explanation for what liquidity is, how it works. You see it all over in the market. So let's give a few examples on the actual chart and then we will move on. So I already marked a few out just to show you, but we will break it down real quick. So we see here is that we are in a bullish market, okay? And then we sweep out the most recent higher high. And from there, we see a strong push lower. What this can tell us is that this high that we pushed past had a lot of resting orders and that sellers were very, basically, they were attracted to this level of price and wanted to see us move lower to make them their money from this high, okay? Now, what happens is a lot of times we see these levels get respected a lot. It is not the only concept that is used for making the market shift. Like if we go on a higher time frame here, we have something called a fair value gap here that pushes us higher to create new structure. This was not a liquidity sweep. Not to confuse you guys, but there is several different areas of price that will see either reversals or continuations from the chart. But for now, we're just sticking to liquidity. So this shifts us on the hourly time frame to bearish market. Also, a really good example of liquidity sweep right here is this high that we leave. We create a higher high, higher lows, and from there we see the market dump and take out the sell side liquidity. Okay. And then also from there we see another shift. So super easy way to put it. We take sell side. Sellers like this point of price. They send it to buy side. Sellers take off their orders at sell side, leaving area for buy side to step back in and send the market back higher. Okay. We have another really good example of a liquidity sweep right here. We have this low that was stepped in the market. Okay. We are creating all of these highs up here for market to be able to reach. Okay. We pull back, we sweep that low and look at the massive moves we see from the market from that area. Okay. Now, another example of market structure shifts. We are obviously in a overall bullish market here. Okay. We are trending higher. We create this high, we pull back, we sweep it, and we have a full market structure shift from that area. Like I was saying, all this means is that sellers really like this area price to be able to overwhelm the buyers in the market structure to see a shift, okay? And then from there, liquidity. We're going to go into fair value gaps more, but we see liquidity get swept back by fair value gap to see a move push lower, okay? Now, we're going to go over just one more. I think there's just one more I marked out. I just want to get you guys some reps in. So we see a consolidation here. We don't want to be involved in this at all. And then we see us push lower and create a structure here, okay? Now, we get a sweep of the structure, and from there, market is pulled back. And then, well, so I want you guys to understand this too. A liquidity sweep isn't always going to make the market just go completely reversed from that area. We are trying to catch a piece of the pie, okay? So even an entry from here, okay, catching it to this most recent buy side liquidity being these highs right here is a win in the market, okay? So you're not trying to catch it to the moon and stars. You're trying to find where sell side is stepping in this situation and target the most recent buy side liquidity. Because what happens is once we reach that most recent buy side liquidity here, you can see that the market does not push higher and we start to push lower again, okay? So liquidity and market structure together are very powerful. You should look on your trading view chart and practice this religiously. Just mark out highs and lows, see which ones get swept by liquidity, see which ones don't. Start to see it all get put together, okay? Let me see if there's anything else on liquidity. Yeah, so, I mean, the biggest thing is like, when you have the right mindset on liquidity, that is going to be one of the most important parts of it. It is literally money, okay? We look at this chart and get caught up in how the candles look and all this stuff. The market still moves by money, period, point blank, okay? So at these highs, when I see price move from them, All I know is that there's a lot of orders stepping in at that area. It's simple as that. It's not because this wick is a certain length or because this candle is a certain close or whatever. It is because there is a lot of money stepping in, period, point blank. Let's move on to the next concept. We got a lot more to go. Bear with me, take notes. Let's get it. Okay, so really quickly, to piggyback off liquidity, we're going to go into the next concept, which is a draw on liquidity. Just to give you guys the lingo, I don't want to just talk about liquidity and leave it there. So this is going to be a little bit of a shorter section of it, but it is still a section. So we're going to literally use this same exact thing we had here. So a draw on liquidity is when you have a liquidity sweep, and then from there, what is price going to be attracted to of where we can put our take profit, where the orders from the liquidity we swept going to be relieved at. So we have examples of this everywhere in the chart. I didn't even mark out anything. We're just going to look through and find them, okay? So for this example, we sweep buy side, or not buy side, we sweep sell side liquidity. So what we can expect from there is the draw on liquidity to be the most recent buy side liquidity. The most recent buy side liquidity at best, okay? So we are not going to try to reach for all the moons and stars here. We are going to go for the most recent buy side liquidity, which is going to be the most recent, when we're in this situation, is going to be the most recent lower high here that we put in before the liquidity sweep, okay? So liquidity sweep is our sponsorship, basically the narrative, and then the delivery is to the draw on liquidity, okay? So we'll get rid of these real quick, and we'll look at a few more. So we see an obvious liquidity sweep here, okay, of sell side liquidity. SSL is the abbreviation for sell side. BSL is the abbreviation for buy side. Okay. What is the most recent high that we left is this right here. Okay. This buy side liquidity. So if we say go down on the 5-minute time frame here, or 15, make it easier for you guys. We do not need to catch it to the moon and stars. Okay. We need to see market create structure. Say we have not reached this buy side yet. We have this liquidity sweep. We pull back and we want to see us continue higher here to the draw on liquidity. That is the narrative that is being put in here, especially after we create structure here. So say we entered right here. We have multiple liquidity sweeps. We have a higher time frame one here. We have a lower time frame one here. All of it is backed up, pushing towards the same draw on liquidity. We have a agreed upon draw on liquidity. Okay. So entering on this and seeing the market shift and deliver to that area means that we had the right bias and the right draw on liquidity. And from there, we can take our orders off, take our TPs off, and see the market possibly present another idea or be good for the day and done. Okay. So let's use another example. We have this high here that gets swept, this buy side liquidity. So what can we expect the draw on liquidity to, the target to be, is this low here, this sell side liquidity, and in this case also this sell side liquidity. We see market shift to those areas after taking our buy side. Let's go to the 15-minute again. Okay. So we see the market start to shift from really this level right here. Don't worry too much about that. And we can target the sell side liquidity all the way down to here in this situation. And you see that price has a very swift and abrupt move to that sell side liquidity because a lot of money stepped in here. When money steps in, the market gets violent. Okay. And we can see that with these massive moves. This is considered an auction at the buy side liquidity. Sellers very overwhelmingly win this auction, sending us to those levels. So that is a draw on liquidity, is when we see a sweep of liquidity, where is it going to go next? Where can we predict the target to be for price? That is the definition of buy side. Let's move on to the next concept. All right, our next concept is a fair value gap. This is such a crucial part of my strategy, how I view the market, and how you can really see, like I'm literally making a puzzle for y'all here. Market structure, liquidity, draw on liquidity, and fair value gaps. They are a beautiful harmony. Okay, so fair value gap. Let me spell it out for y'all just so you understand fully. Okay, fair value gap. It is literally what it says. It is fair value in the market. It is imbalance in the market. Basically a place within structure for buyers or sellers to be able to reach that area to continue the trend higher or lower. So It is a 3 candlestick pattern where the first and third candlesticks wicks do not meet in the middle of the second candle. Okay, so we are going to give a bullish and bearish example on this diagram, and then we'll move to the charts. Okay, so for the bullish fair value gap, we see the first candle, the top wick, and the third candle's bottom wick do not meet in the middle here. Okay, there is a void in this area where it is just the second candle's body. So we draw our fair value gap from, in a bullish fair value gap situation, from the top wick of the first candle and the bottom wick of the third candle, and that is our bullish value gap. How price will use this is that we can come back into this area, give buyers in this situation a opportunity to fill more orders to continue higher to create a higher high. Okay, the reason why is that this is a unresisted area of price. It is imbalanced. Okay, price was able to move very swiftly through this area of price. That's why we have a void here. So that means that, hey, buyers get to basically have a cheat code. There's not much resistance here in the market. Let's go there to be able to continue our trend higher to make more money off of this. Okay, so that is for a bullish for value gap. A bearish for value gap is literally these. It's still the same 3 candlestick pattern, but it's the opposite for the wicks. It is the first candle's bottom wick and the third candle's top wick do not meet in the middle. There's a void of just the candle of the second candle's body of the pattern. We draw that from there. Once again, how we can use this in a bearish scenario is when sellers want to keep control of the market. They want to create lower pushes, create more structure. They can play into this because it's imbalanced. It was able to move swiftly through here. They know there's little to no resistance at this area and then push the market back lower. So fair value gaps are, in this case, a continuation level for the structure that we are currently in. Also, the best way to remember it is a bullish for value gap, price has to trade down to be able to reach it. And for a bearish for value gap, price has to trade up to be able to reach it. That's a good way to remember and not to forget. Let's move into the chart real quick to see some in actual action and to see them really work. Like, these are one of my favorite and top concepts in the market. Let's go to the 4 hour just so that we can see some cleaner stuff. Or actually the hourly might still be good just so we can see a little bit more. So we're going to use them over and over again. Okay. So, we're just going to literally let's start back here and then go from here. So one of the first things we see here is we have a 3 candlestick pattern right here. 1, 2, 3 candles where the top wick of the first candle and the bottom wick of the third candle do not meet. That would be a fair value gap. What do we see? Price trades into that and we create a higher high. A continuation from buyers at this level to be able to continue price lower. Okay. And then what do we see on the flip side? We have a bearish value gap or this 1, 2, 3 candlestick pattern here. The bottom wick of the first candle and the top wick of the third candle do not meet. And we perfectly tap that and create lower lows from that area. Okay. We can literally just go on over and over again. We have a bullish value gap in this scenario. 1, 2, 3. Top candle of the first wick. Top wick of the first candle. Sorry. And the bottom wick of the third candle do not meet. We tap that to be able to, this is bringing liquidity into this. We use this to deliver to the buy side liquidity for sellers to be able to step in. Okay. So catching the trade from here to here is a very good trade. We have a agreed upon draw on liquidity using a fair value gap to deliver to that draw on liquidity. Okay. So let's get rid of those and let's just keep on going here. We have this for value gap right here. 1, 2, 3. First candle, top wick, third candle's bottom wick do not meet. We tap that and we see big pushes higher. Let's just keep going. This is a very good part to mention. Not all fair value gaps are made the same. I don't want to confuse you all too much at this point, but certain fair value gaps back from certain levels are going to be a lot higher probability and ones that I'm going to want to actually put my capital on. Don't worry about that too much now. Just worry about fair value gaps. Understand the mechanical way to use them. So let's just keep going here. Once again, we have this 1, 2, 3. First candle's bottom wick, third candle's top wick do not meet. We tap that. We show resistance for a little bit. It does end up failing. Just to show you guys all different scenarios here. Once again, 1, 2, 3. First candle's top wick, third candle's bottom wick. We tap that to create a draw on liquidity. We deliver to buy side liquidity from there. And then we see reversals. And then from there, we use that sweep on liquidity. Sellers step in. It gives them another opportunity with this bearish fair value gap to step in to see a push lower. So I hope that helps you all understand how fair value gaps work, how they mechanically are drawn. Make sure this is another thing. Drill this in your mind on the charts. Draw it over and over again to see them play out. Okay, we have another one right here. Bearish fair value gap. Tap into it. Send lower. Once again, we are in a very strong bearish market, so we keep tapping them and sending lower, giving sellers opportunities over and over again to be able to send the market lower. Very strong confluence of how you can have a very easy and also just mechanically or historically backed level to be able to use to catch the money in the market and continue to trade it. Okay. Once again, sellers step in here. We have a massive one right here. Sellers step in here. Okay. And over again, it just continues to print. It is an amazing level, especially when you're able to bring it together with market structure, draws on liquidity, and the overall narrative of price. Let's move on to the next concept. All right, the next concept we are going to go over, piggybacking right off of fair value gaps, is an inversion fair value gap. So we already know a fair value gap is used to continue price. Well, fair value gaps can also be used paired with other things to be able to predict when market could be shifting structure and we could be reaching for a new draw on liquidity. Okay, so we are in a bullish market. We're going to give a bullish and bearish situation here. We are in a bullish market and we have this bullish fair value gap right here. What happens is we're going to use the full encompassment here. We come and we sweep out buy side liquidity. And then from there, we get a candle close past the bullish fair value gap on the new structural leg. Okay. The wick does not matter. You can wick all the way through a bullish fair value or any fair value gap and it does not invalidate it. But if we get a candle close past it, that is when we could see in the right market conditions with everything encompassment put together that we could be agreed upon for a new draw on liquidity, which would be sell side in this situation. So we are respecting bullish. We disrespect the bullish fair value gap by closing past it, making it an inversion fair value gap. And that could be a point where we could possibly enter in a trade and trade to the sell side liquidity. Okay. Also, for a bearish example, we have a bearish market creating lower highs and lower lows here. We are respecting a bearish fair value gap, and then we sweep out sell side liquidity here. And on the structural leg that created the lower low, we get a inversion of the bearish fair value gap, an inverse fair value gap, which is a body close past the fair value gap box that you drew out. Make sure you're practicing fair value gaps, how to probably draw them out before you worry about inversions. But this could be a sign that market is going to be delivering on a agreed upon draw liquidity of buy side liquidity. Okay. So that's how inversions work. Let's go to the chart. This is going to be the best way to get inversions down, is to just see them on the chart. Okay, so on the hourly time frame here, we are bouncing off a bearish value gap, Okay, what we see is we put in a lower low, sweeping out sell side liquidity. On this new structural leg here that we make, we have this small little bearish value gap. Okay, we do not get a wick past it. We close past this fair value gap with the body, not the wick. The body closes past the fair value gap. So this can be a place where we could enter a trade, putting our stop loss below the low of the liquidity sweep and targeting buy side liquidity, okay? Which buy side liquidity is the most recent highs. And what we see is we achieve those areas, boom, bada bang, easy way to use fair value gaps and buy side liquidity to make a very reasonable trade. Okay, let's go to the 30-minute and get into a little bit more advanced inversions and how you can use them overall in the market. Okay, so we have multiple things going on here. It's a little bit noisy. We're like, what is going on? So the first thing we are going to look at is we're going to mark out the fair value gaps in this range. Okay. So we have this first massive fair value gap. We're not really going to worry about this too much. What we're going to more worry about is this small little one here. You can see there's a small little gap right here. With fair value gaps, size does not matter. They're all made the same. Imbalance is imbalance, period, point blank. So this would be a 30-minute bullish fair value gap. Okay. It's hard to see the writing, but it is there. Okay. Now, what do we have leading up to that fair value gap? Well, the first thing we can look at is this liquidity sweep of buy side liquidity. Okay. And we have a bullish fair value gap here. And what does happen to this fair value gap? We tap it, we respect it at first, but then we get a strong close past that. So what does that mean? We could be delivering to an opposing fair value gap or to opposing liquidity. Okay. So I personally wouldn't do this because of the area of price. Don't worry about too much, but you could enter in this trade technically and target this bullish fair value gap because we get an inversion because we get a strong close past the fair value gap with the body. Okay. Now let's get into the real good trade presented here. Okay. We tap this fair value gap with this structural leg right here. Okay. And we have a bearish fair value gap right here that we open with price. You can see the first candle's bottom wick and the third candle's top wick do not meet. That is a fair value gap. And what we get paired with a tap of a fresh bullish fair value gap is a close past that. We can put our stop loss below this low and we have a lot of buy side to be able to target. Okay. We have this buy side. We have this buy side. We have this buy side and this buy side. All these different draws on liquidity that can be targeted. And with a fair value gap and a inversion, using bullish and bearish together to see what is being validated versus invalidated, you can form a trade idea to be able to catch the move to the draws on liquidity, which would be buy side liquidity in this situation. Okay. We will find a few more quick examples just because. Why the frick not? Yeah, this is a good example here. So we have this fair value gap, this bearish fair value gap. What ended up happening? We close past that. We have an obvious buy side liquidity here. Okay. With this inversion, we can enter on this. Of course, with the right narrative of price, and we can target the buy side liquidity. Okay. Now, what happens from that buy side liquidity is that we get a sweep and we see pushes down. Now, if we go on a lower time frame, something like the 15-minute maybe, we can get a trade idea from using multiple time frames. So we did not see a fair value gap on the 30-minute here, okay? There is no fair value gap in this structural leg to the buy side liquidity. So let's drop a time frame and see if there is another opportunity. And there is. We have this 15-minute bullish fair value gap right here, okay? And we have obvious sell side liquidity that price could deliver to. So on and so forth, all the way down to this main low right here. So we get a strong close, not the wick, the strong body close passes fair value gap. So this could be where we could enter our trade. And we can target all this buy side liquidity. And you can see market is very aggressive and flushes straight to our sell side liquidity in the situation. So how can you pair this all together? You get a liquidity sweep, a buy side liquidity, an inversion of a bullish level. So showing that buy side liquidity, sellers stepping in here is real because you get invalidation of a bullish level, and then you just target your sell side liquidity where the sellers might want to take their orders off that they entered with up at this level. Okay. So that is it for inversions. Let's move on to the next concept. All right. Next concept is intermediate highs and intermediate lows. This is the last part that does specifically more with the overall mechanical systems of fair value gaps and all the ways they can be used. But really quick, just because I'm not 100% sure if I broke this down fully, is what actually identifies as a high and a low. So a high is a 2 candlestick pattern. It is a bullish and a bearish candle. And the highest wick of those 2 candles is your high. A bearish candle is literally the exact opposite. It is a bearish, then a bullish candle, and the lowest wick of just those 2 is considered your low. I did not know if I completely made that clear yet, but I just wanted to make sure I got it out of the way. So bullish and bearish candle, highest wick of those 2, that would be this bullish candle. That would be your high. You have a bearish, then a bullish candle. The lowest wick is the bullish candle again in this area, so this would be the low. Now, to give an example of this, we have a bearish and a bullish candle, and then this candle. What wick is the low? It would be the bearish candle, okay? It is only of the 2 of the pattern. In a low, a bearish and bullish candle, just those 2. And in a high, a bullish and bearish candle, just those 2. So the lowest wick in this situation, because the low is a low. So this is an actual low of liquidity, and you can see market swept this as sell side. If you would have marked this out as the low, that's not the actual mechanical low, okay? So I hope that makes sense before we get into this. So intermediate highs and lows are the initial high or low, depending on the bullish or bearish fair value gap that was left inside of the gap, okay? So in a bearish fair value gap, it will be the first high that was left inside the fair value gap when we respect it. So we have a few marked out. We're just going to keep working through them and showing how it is. But intermediate highs and lows are very, very strong draws on liquidity, okay? There are not just swing highs and lows that are draws on liquidity. There are certain swing highs and swing lows and highs and lows in the market that hold the most power. And as we know, fair value gaps are used as a level for buyers or sellers to reach that area and continue the trend and to fill their orders from that area. So naturally, once we pull into a fair value gap and we leave a high or low, depending on the fair value gap, in that area, there's going to be some orders resting in that area. So let's go through a few examples here. We have a bearish fair value gap, the first wick's bottom wick, first candle's bottom wick, and third candle's top wick. We pull into this fair value gap and we create a high, okay? A bullish, then bearish candle. This is the intermediate high. So what happens is price doesn't just keep inside of this fair value gap and doesn't close past it, disrespecting it. It sweeps this to claim more money, to basically trap buyers to fill all the remaining orders in this area. And we see a massive, massive rejection from this area, okay? Intermediate highs and lows and fair value gaps paired together with overall market structure is literally my strategy, okay? There is more to it that you have to understand, but stupid simple wins you money in trading. Stupid simple gives you a high win rate. Stupid simple gives you a repeatable process, okay? So intermediate highs and lows are a very crucial part of my system, and I very, very highly recommend that along with fair value gaps, market structure, all these things, you learn to see them, you start marking them out, and learning how they move, okay? Let's go into another really good example of how strong they can be even later in market history, okay? So we have this bullish fair value gap, 1, 2, 3 candle, first candle's top wick, third candle's bottom wick. We tap into this, really good tap that also delivers us to buy side liquidity. That could be a trade. But look what happens. This much later in market, after a massive down move, it goes all the way to this initial intermediate low, and that is what reverses the market, okay? So even, when is this? Thursday, all the way to Friday, a week almost later of price action, it still respects this level, okay? So intermediate highs and lows are very, very, very crucial. They're very important. They move the market very well. So also, to pair with intermediate highs and lows, we want to see actual involvement from the fair value gap, okay? This is a way to be able to filter out bad internal highs and lows versus good ones. We can see when we tap into this level, we don't just tap it and then like start chopping around, okay? We tap it and then we create a new higher high. We show intent from this fair value gap that orders were stepping in at this area. So that means that there's orders resting here. The buyers that stepped in, their stop losses are at this level, okay? And also limits to be able to go lower here. There's orders at every high and low, but specifically intermediate highs and lows, that show intent once they're hit and send the market in the opposing direction are very strong levels. And this shows this much later in price, it reverses the market. Okay, let's go into a few more. So once again, we have a bullish for value gap, 1, 2, 3 candles here. The first candle's top wick, third candle's bottom wick, do not overlap. We tap into this and we create a higher high. Okay, so that means that there's some intent here and that some money was able to step into this area. Okay, so what ended up happening is we come and we perfectly tap this intermediate low before we see a more aggressive breakout of this area, continuing a even larger bullish market structure all the way to all of these buy side liquidity. Okay, so you cannot argue with the facts. Make sure you're going on your chart and marking these out. So once again, this is a very, very, very good example because this is going to show you the power of these. So we have a bearish fair value gap in this situation. We have 1, 2, 3 bearish fair value gap. We tap into it. We see a very good push. We end up kind of chopping around a little bit and then delivering. Even in this situation, because of the orders that were put in here, market was basically in a larger auction here. What happened? This initial high wasn't taken by this, and we generated more buy side liquidity at this area. We come up, we perfectly tap the intermediate high, the first high that was left inside the fair value gap, and then we see a massive relief all the way to this major sell side liquidity. Okay. We have, I think it's one more example here. So we have this fair value gap, bullish fair value gap, 1, 2, 3 candles. Okay. We tap into this and we see intent by the overall just movement of price from the fair value gap, creating a new higher high from this level right here. Okay. What ends up happening is that first low left side of the fair value gap, we perfectly tap that, and then we see a delivery to our buy side liquidity here, the first buy side liquidity. So a trade within this area, depending on the lower time frame here, could catch you to this buy side liquidity. So intermediate highs and lows are very important. They move the market very, very well. You can see them almost everywhere inside of the market. There's probably some over here that we could find from today. Let's see here. Yeah. So we have this bullish value gap. We tap it. Literally, we don't need to fill the whole thing. We just need a little tap right here. You guys see that? Let me zoom in a little more. We just need a little tiny tap of that fair value gap. Okay. And what we see from there is intent. We see the market deliver to buy side liquidity from that fair value gap. So that means that there's money that stepped in at this low. Okay. Buyers were able to step in here. What ends up happening? We come and sweep that intermediate low later in the session, and then see us return to all of these buy side liquidity points. Okay. It works very well, a very strong tool and level to use for liquidity in the market. That's it for intermediate highs and lows. Let's move on to the next concept. All right, next concept is displacement. Okay. This is a single candlestick or a series of candlesticks that show basically violence and aggression in the market towards a certain draw in liquidity from a certain liquidity point. Okay. So you guys know, usually with a candle, there's your body and then your wicks. Okay. A displacement candle is going to have little to no wicks, and it's going to be a very strong and aggressive close that are usually going to be larger than the surrounding candles that show from a certain level intent to a new draw in liquidity. So when you look at this chart, you can see a lot of very strong candles, different sizes of candles, but there's certain ones that stick out. And we're going to use this one over here as a situation, as a example of this situation. So we have this sell side liquidity. After sweeping that, we get this very strong no wick on really either side, little to no wick on the top side, no wick on the bottom side, showing displacement and intent. So what that means, it's kind of the same as a fair value gap. That once we reach certain levels and it is backed by a displacement candle, then what it means is there's little to no resistance for price to be able to fill orders here. Buyers were able to step in, and there was little to no opposing sellers trying to fight against this move here. Okay. So What that means is we can expect for buyers to be able to very easily take consistent control of the market. Okay. And since then, we have not seen any candles anywhere near the size of this first displacing candle, this bullish displacing candle. We pull into this massive fair value gap that was left inside the displacing candle that sends us higher into a new market structure of higher highs and higher lows here. Okay, there's a lot of examples of displacing candles. They have to be paired with a proper draw on liquidity, a proper fair value gap, and a real draw on liquidity being delivered to that is intentional for price. Okay, so let's use an example here. This candle, this bearish candle right here at 3:35 in the morning, what is wrong with this? First of all, we do not sweep out this buy side liquidity. We come right under it and generate another point of liquidity. And we are literally just displacing into bullish levels for us to continue higher. Okay. So displacement can be used in two ways. It can be for angst and quickness to a level to continue in the opposing direction. Or if you've already reached those opposing levels, it can be used as a symbol that we are going to be reversing from that area. So just because we displace here doesn't mean we just go short on the market. Okay. That is completely ignorant of price. That's not what price is telling you. We have not reached an opposing level yet, and we do not need to expect for market to see a full reversal yet. We are still showing bullish momentum, okay? Now, let me use an opposing example. I'm literally just finding these as I go because they're literally everywhere. All right, in this situation, we sweep out the buy side liquidity, okay? And we have a bullish fair value gap that actually sends us to this area, okay? So this right here is a trade in and of itself from this gap to this buy side liquidity, okay? But what do we see? We come in this gap and then we see a massive closing bearish candle that are larger than majority of the candles around it, okay? That is not just inversing that, but it's backed by liquidity. You can put your stops up here and you have liquidity to target to the downside, okay? It does take a while, but market does deliver down to those areas, okay? So displacement is this showing large amounts of money intending towards a certain direction of price, okay? Also, you can pair it with a whole bunch of other random stuff too. We have a bearish value gap right here. The first high put inside of it was, well, technically this, but this main high here. We sweep that in line with displacement and we continue going lower from there, okay? So all these things put together is basically just this displacement is showing intent. So you're not going to take any of these concepts in and of themselves to make a good trade idea. So for example, I'm not going to take a random fair value gap, ignore everything else price is telling me, and predict my whole trade off of that one fair value gap. Same with liquidity, same with displacement, same with inversion fair value gaps. When all of them come together, pointing towards the same direction, that is when I am going to be looking to step into the market because now we have alignment, we have intent. So displacement, I'm going to give you all A+ example here. Displacement after, we're going to use this down here actually, because we see displacement that's not actually showing this. So we have buy side liquidity, buy side liquidity. So what we can see here is that the market takes out this major sell side liquidity, and from then we have been seeing bullish movement, okay? A full V shape of this whole entire structural leg, which V shapes recoveries are basically just a lot of intent, okay? We generate another point of buy side liquidity right under this one. We're going to get into what that's called actually in a minute. And what we see is we trade into a fair value gap here, and we perfectly tap that, okay? We see displacement to that fair value gap, but then what we see out of it is we create a bearish fair value gap from this displacing candle, and we inverse it. We get a close past it with this candle. So now we're not just taking displacement on this that's not backed by everything else price is telling us. We're now waiting patiently, and we get an entry with everything in alignment, okay? And this is when we're able to make very successful trades, see very fast price action and movement all the way to this main sell side liquidity. I mean, buy side liquidity up here, okay? Wait for alignment. That's how displacement is used. It's used in confluence with everything else we've talked about. Let's move on to the next concept. Now we're going to talk about high resistance and low resistance liquidity. These are one of the two concepts that are kind of one together, but the two concepts that I use daily. You can watch in my trade recaps, my pre-market analysis. I'm constantly talking about high resistance and low resistance liquidity to shape my bias for the day of what I want to see the market do. So what exactly is high resistance for low resistance? Well, first, let's give a quick definition. When you hear high resistance and low resistance, what do you think that means? It means exactly what it sounds like. High resistance is a level in price where it is going to be a lot harder for market to re-achieve. Low resistance is an area in market where it is most likely going to be very easy for price to achieve that area because of the money that is at high resistance versus at low resistance. Okay, so let's make a few quick explanations with this diagram, and then we're going to hop into a few examples on the actual chart. So low resistance liquidity, the simplest way to put it, it is two or more highs or lows stacked on each other. Okay, so for example, if this high right here went past this, it wouldn't be high resistance anymore. We need two or more highs that do not take out the most previous one, okay? We need them to stack on top of each other because remember, liquidity lies above highs and below lows. So what happens if we don't just have one high, but two or three or four highs all stacked on top of each other that all have orders resting at them? Same with the bottom here. We have 1, 2, 3 lows all stacked on top of each other. If liquidity rests at lows, 1, 2, 3 is better than just one, okay? So mechanically, what does this mean? What is the actual thing going on here in price? When you see the market constantly go to a low, get really close to it, and then reverse again, and build low resistance liquidity at that area, a trend line, what that is, it's leaving orders for a specific party, buyers or sellers, to be able to achieve the opposite end of price and to be able to use that as a very strong target. It's a generated target for a buyer or seller side of the party. That's the way I view it. It is an auction that's being put together as a guaranteed target, basically. It's a magnet. So the way I want you guys to view it, low resistance is a money magnet. High resistance is a money pusher awayer. Okay, that's what we're going to say. We are very unlikely to reach high resistance without first reaching the opposing low resistance. So there's two examples I'm showing here. We're going to break this one down first. Once we take out low resistance liquidity, what we have left is something called high resistance liquidity. We sweep these areas, and then from there, we start seeing a reversal, okay? That means that this is now generated high resistance liquidity in the market, and it is very likely for us to want to seek these low resistance draws on liquidity, okay? Same thing over here. What is the opposite of low resistance liquidity is high resistance. Now, what makes something even more high resistance is a high that continues to take itself out and not take out the opposing draw and generate more low resistance liquidity instead of taking out the opposing lows in this situation. So the more highs that are taken out and then liquidity generated is making this higher resistance. So say we keep creating this high resistance all the way up to this fair value gap. Say if it's a high time frame fair value gap that we do not want to trade until we reach this level. We are continuing to put in high resistance, and we put one in inside of a fair value gap at a level that we are willing to trade from. And then say from there, we get an inversion fair value gap. What we can highly anticipate through everything the price in the market is telling us is that, hey, this is a strong level that will not be breached by price. We can now expect for us to run this low resistance liquidity and to see the market attain those levels because there's a lot more money at all the lows here that have not been reached by price than this one high that has filled orders for sellers to be able to step in and send us lower. Okay. So in this situation, you could enter in this, put your stop loss at high resistance because that is going to be a protected area, and then target the low resistance liquidity. Okay. Let's step into the charts real quick and break some stuff down. We have a few examples here. I think we just have 3 of them, but we'll go over it. So you can see we are generating low resistance liquidity on the top and bottom side here. All of these lows is stacked up on top of each other. Okay. All these highs is stacked up on top of each other. And what we see is that market comes and decides to take out the sell side of this liquidity. And then we put in high resistance liquidity. And what we see happen, literally just like the diagram, is we see delivery all the way to the opposing buy side low resistance liquidity. Okay. These over here too, these two highs stacked on top of each other are low resistance liquidity. And we see market come and take out these initial high resistance liquidity. And then we take out the main lower, not high resistance, this main low resistance liquidity and this low resistance liquidity as well. Okay. So once we take out low resistance and we do not have any more draws to take out, because this is also high resistance. Okay. We take out all these lows here. So we don't need to reach this level in price because this already took out low resistance. Same here. Same thing here. We took out low resistance. This doesn't need to be reached anymore. We could see price have a very easy, quick, and obtainable flush all the way to the low resistance liquidity. And that's what we see happen here. Okay, let's move on to another example. So we see that market is taking out these highs over and over again, creating higher and higher resistance. Okay. And then what we see, I'm actually not 100% sure if there's a gap here, but I'm going to be willing to guess, put my money on there is. So let's look. Yep. Cool. So we have this hourly fair value gap here. Y'all see that? Okay. Right here to right here. Boom. That's just how you can use the higher time frame to see an actual involvement of an area. Okay. So we take out the buy side liquidity here. We pair it with this inversion fair value gap. Boom. And what we can do is we can target the low resistance liquidity because we have punched through and made high resistance. There's no more draws to take out over here. Okay. But what we have is all of these lows stacked on top of each other, which is money, money, money. It is a magnet for price. Okay. So we can just target this low resistance here. We can target this draw on liquidity. We have a lot of places that we can target. Okay. But fact of the matter is we take out and put in high resistance and we flush to low resistance. Okay. One more example of high resistance and low resistance. This was actually today during the market. So what we do is once we take out this low over here, that sweep, this is high resistance liquidity. High resistance liquidity stays high resistance until there's low resistance generated with it. Okay. So today in price, I did not expect us to need to take this out. And what we do is we have these two lows right here. This one that's already marked out and this one, this low resistance. What we do is we take that out, put in high resistance, being this low right here. And then we go and we deliver to all of this low resistance liquidity up here with all of these highs stacked on top of each other. Okay. It is tried and true. One of the most predictable and easy ways to consistently see results of delivery in the market using the method of high and low resistance. Okay. That's it for this concept. Let's move on to the next one. All right. We are going to go over a concept that you're going to hear a lot in the trading space, something that you need to know to have a real full encompassment of everything together. And the word is sponsorship. Okay. So you probably already know what the definition of a sponsor is. It's something that basically assists towards a goal, or in the market, it's a level that assists towards another level. Okay. So the biggest ways we can use sponsorship is literally all the things we already talked about. Fair value gaps, internal highs and lows, and low resistance versus high resistance liquidity. Okay. So it is a very vague term, but we're going to break it down real quick. We have a 1 hour fair value gap here that after seeing displacing 1 hour candles, okay, we can expect after also inversing this hourly bullish fair value gap that we can continue to see the market move lower here. Okay. So this 1 hour fair value gap A bearish fair value gap is a sponsor. Okay, it is a sponsor of price to be able to see a push lower. So now we're going to go into why sponsorship is more important on the lower time frames here. Okay, so we're going to use this example over and over again. We have sponsorship of a 1 hour fair value gap paired with high resistance liquidity and low resistance liquidity on the bottom here. Okay, and now what we have is a continuation of the sponsorship. So any fair value gap that is made within this level before we reach this main swing low, which is where liquidity lies in the situation, is a sponsored level. So we have this 5-minute fair value gap right here. What happens, because it's sponsored by a higher time frame level, we reach that and send all the way lower to this sell side liquidity. Okay, we're going to keep breaking this down lower and lower here. So that's the first sponsorship. Let's go to something like the minute time frame. We got to find it first. Okay, so we have our hourly sponsorship, our 5-minute sponsorship, and what we see is that we continue to hold because of sponsorship. We have a 1-minute gap right here that holds and sends lower because of sponsorship. Everything is from top down. So we have a higher time frame level as sponsorship. We get a 5-minute and then even a 1-minute that all holds, all because of this high resistance within a sponsored level, which is the higher time frame fair value gap in this situation, that is able to send us lower. So I don't want you to overcomplicate it too much, but simply put, sponsorship is just what you need to see as, hey, a level in price is willing to send us in a direction. We have confirmations and consistent validation of that sponsorship. So we're not going to want to trade against that until we have a new sponsorship and have a new intent from price. Let's see if we can find a new sponsorship that reverses us from this area. So, perfect. We have this major swing low in the market, okay? This is very strong sell side liquidity. What you can see is that from this hourly sponsorship, we continue to be sponsored by these 1-hour gaps until we reach this main swing low, okay? This is a very major swing low. All the way up to the even daily time frame, this is a very strong swing low. This is a daily intermediate low, guys, okay? We have this daily fair value gap. This is the low left inside of it. This is a very strong liquidity point in the market. Okay. So now that we reach this, oh, that's the wrong time frame. Now that we reach this, we can expect new sponsorship for price to be able to want to reverse. So there's several things that you can do here. You can take this first inversion. Because we have sponsorship, we have high resistance liquidity here. We take out this low, and we're sponsored by this higher time frame level. This is high resistance. There's nothing else over here to worry about. And we have all of these highs that are stacked on top of each other up here. Okay. So we have high resistance trading to low resistance with a sponsored high time frame level. What can we expect price to do? It's to see delivery to this buy side in this situation. Let's break it down a little bit further to see if we can find sponsorship from the sponsorship. Okay. So cool. We got a high time frame buy side or sell side liquidity sweep of a daily internal low. We get high resistance put in. We have low resistance at the top side. Everything seems to be checking its boxes. We get that 1 hour inversion fair value gap of the bearish fair value gap showing bullish momentum. Now we get to piece it together with the last piece of the pie, a confirmation of a bullish level. Okay. So on the 30-minute time frame here, we have this 30-minute fair value gap that is not just paired with that 1 hour inversion, but a strong displacement candle on the 30-minute time frame. What ends up happening is we tap that. We use that because it's a sponsored fair value gap because of this daily internal low sweep, and we seek out this buy side low resistance liquidity. Okay. That is sauce right there. I just gave y'all a full freaking 5-course meal pledge of everything you should need to see for an A+ trade. Okay. We can keep breaking this down here, y'all. We see this 5-minute gap that is opened within this 30 minute. Okay. Once that gets inversed, which is right here, that's our full confirmation to be able to catch a trade all the way to the buy side liquidity here. Butter. It's not easy, but it is easy as that. Continuing to practice these levels, understanding how they work, is going to bring this type of consistency to be able to view the market in this type of light. So that's it on sponsorship. Let's move on to the next concept. Now we're going to dive really quickly into a smart money divergence, aka a SMT. I do personally use these. They are not my biggest confluence. They definitely work, but really are, you have to filter them down a lot. We talked in, I think, the last chapter, chapter 1, about how NQ and ES are correlated assets. You need both of these, and you should be charting on both of them regardless to be able to spot SMTs. So basically what it is when NQ and ES have a difference in a higher high and a higher low situation, or a lower high and a lower low situation. Okay. So this is NQ and this is the ES examples on the diagram, and then we'll get into the charts. So on NQ, we pull up and we take out the most recent high, but this same high on ES, we failed to take it out. This is a bearish SMT. The way I like to explain it is NQ is like, hey, let me go take out the liquidity. And ES is saying, okay, cool, I'll hold structure for bearish momentum for us to be able to change character from here. Okay. So NQ is like, hey, I'll take out liquidity. ES is cool, I'll make the new structure. Okay. That's the way I like to view it. A bearish SMT is always going to be with highs. Always going to be with highs. And a bullish SMT is always going to be with lows. Bearish SMT always with highs, bullish SMT always with lows. Okay. So bullish SMT, a bearish SMT is when either NQ or ES, one of them is creating a higher high and the other one is making a lower high. Okay. Now for a bullish SMT, it's the exact opposite. It is when, say, NQ in the situation fails to create a lower low and ES does create that lower low. Same thing in this situation. ES is like, hey, I'll take out the liquidity. NASDAQ is saying, okay, cool, I'll create the new structure. So we can see that we create a higher low while ES creates a lower low. That is a SMT. Okay, let's get into the charts and show some examples. We are going to be using both NQ and ES for this example because you do need both of them. Okay, so our first SMT we're going to be looking at is at these lows. Okay, so you can see on NASDAQ, we failed to take out the low. Well, once I go, we failed to take out this low while ES takes out that low. Basically, once again, ES is saying, hey, let me take out the liquidity. NASDAQ's like, cool, I'll hold the structure. And then from there, we see full market shifts. Okay. I will say these SMTs are not good standalone. They need to be paired with high time frame for value gaps, with inversions, withdrawals and liquidity, with high resistance and low resistance liquidity. All these things get pulled together, but they are a confluence and a tool you can use in the market to just add to your, basically your ammunition of your confluences for your trade. Okay. So that's a very good example of a bullish SMT because bullish SMTs are always at lows. Okay. Let's move on to the next one here. We see another bullish SMT. We see that NASDAQ in this situation comes and sweeps out this major swing low, and ES is very much nowhere near that swing low. Okay. So once again, NASDAQ's like, hey, let me take out liquidity. ES very much in this situation is like, okay, cool, let me hold structure. What we see from there is that, especially on ES, we see a full retracement and push higher to these highs and these draws in liquidity. Okay. So it's paired with liquidity and structure working together, basically. So our next SMT here is a bearish SMT. We can see that ES sweeps out this high, which is buy side liquidity. NASDAQ stays under this high. From there, we see the continuation lower to these draws on liquidity. Should have a few more in here. Yep. So we have another situation right here with a bearish SMT, because bearish SMTs are always at highs. we sweep out this high on NASDAQ, and we fail to sweep it out on ES, creating SMT, and from there, we see a very sharp move down in structure. And that's it. Those are all of our examples for SMTs. Once again, they are important to know, important to be able to see with your eye and train your eye to see them, but they are definitely not like, oh, there's an SMT, I'm entering in this trade. It needs to be in line with everything else. We do not take trades on any of these concepts I'm teaching you standalone. When they come together, like I was saying before, is when they are the most powerful. Let's move on to the next concept. Okay, now we're going to talk about session levels, which for me, the only session levels I use are previous day highs and previous day lows, and then Asia high, Asia low, London high, and London low. Today was really a perfect example of how these levels can move the market in the right market conditions, basically. So previous day highs and lows, all they are is when you go on your chart and you mark out, so you see the current day that you're on, all you're going to do is you're going to mark out the previous day's high, the wick. This is the highest point of the entire candle. That is abbreviated as PDH, and then the previous day low, okay, which will be abbreviated as PDO, okay? Now, let's find some examples of when previous day highs and lows actually move the market, okay? So, this is a very good example right here. We see this candle, previous day highs right here. Once we sweep that, it helps us be assisted to be able to move lower. What's another good example here? Once again, previous day highs right here. Once we are able to reach those, it's assisted to be able to move lower. Let's find an example of previous day lows here. Okay, once again, very good example. Previous day lows, they're swept, used as a confluence, added to be able to go higher. Once again, previous day highs here, used as an example to go lower. Previous day lows here, used an example to get higher. Okay, previous day lows here, once again, used to go higher. All that it is, it's not some magic line like any of these other things. So when you take a daily candle, the highest and the lowest point of that is going to be a lot of the liquidity that was traded in for that day, okay? Where price trades within a trading day, there's a lot of sessions in a trading day. There's New York, which is the strongest, London and Asia session. Those are the three main trading sessions. New York is not the only trading session. There are other trading sessions that are putting in money in the market. The market is international, okay? So we need to view it in that light. So previous day highs and lows within the right market conditions with other things in alignment can be used as when we reach that point, a lot of the existing orders from the old trading day can be relieved or executed further at those levels, okay? So it's just another strong point of liquidity. Now, basically a micro previous day highs and lows is session highs and lows. All they are is basically previous day highs and lows, but for a lot amount of time. So I use an indicator for this just because it makes it easy. Asia session is from 8 o'clock in the afternoon or in the evening, 8 p.m. to midnight. And then London session is from 2 a.m. to 5 a.m. And then New York is from 9:30 all the way really until 4 p.m. So 9:30 a.m. to 4 p.m. But we only trade from 9:30 to 11, like y'all know. So this is the same thing. Within a session, Asia session, London session, New York session, the highs and lows of that session are going to be a lot of the money resting from what was traded within that session. So we can look at Asia and London levels today and what they did. We swept out Asia lows. And what we see? We saw the market shift from there because there's a lot of money resting at the low from the Asia session. We go all the way until we reach the Asia high. What happens when we reach the Asia high is that we see the money that was resting at Asia session take control of the market again. And now, just recently, within the last 30 minutes, we swept out London highs. And what we're seeing from there is market is starting to shift. So these are very strong levels to use in confluence with other things. Once again, none of these concepts are good standalone. I'm going to keep repeating that because I made that mistake a lot when I first started trading. I would use a lot of these concepts standalone. They come together is where they're the most powerful. It's like the infinity stones. You need all of them are better than one. You know what I'm saying? So that is session levels. Go on your daily chart, mark out previous day highs and lows. I mark them out every single day if they haven't been reached yet. for my trading session as a possible draw on liquidity to either trade to or from. So very strong levels. And also with the ICT kill zone and pivot indicator, makes it very easy to mark out your session highs and lows. Let's move on to the next concept. Okay, really quickly, we're going to go on the difference of consolidation and delivery. You kind of already understand what that is, but I'm just going to show you a few real life chart examples. So we went over market structure types. What does this look like to y'all? This is obviously a consolidation range, okay? Where market is not made of its idea yet, and we do not know what the full encompassment of the story that price is going to tell us, okay? So consolidation, what changes is we come and we sweep out all the low resistance here at the bottom of the consolidation range. That is now delivery. That is now intent, okay? And then we see opposing delivery because, once again, putting in high resistance, taking out low resistance, we're going to target the opposing low resistance. So we do not want to be involved with price in here. Don't get caught in it. Wait for delivery. Wait for intent to show and aggression to show in the market. That's when we're able to step in and be able to catch delivery that's stepping in, okay? So I just wanted to put that out there really quick. Let's see if we can find one more example just to show y'all just the power of waiting until the market is out of consolidation. Let's see here. Yeah, this is a good example right here. We have a lot of little consolidation ranges everywhere in the market. We have this little consolidation range. We have this little consolidation range. We have this one up here, okay? All these different consolidation ranges. Wait until the market breaks out of it to be able to look for a proper trade, okay? It is going to save you a lot of unnecessary losses. Wait for delivery because delivery is money. We do not want to be trading when money is absent. So in consolidation, what does that mean? The market has not made up its choice yet. Money is not basically told us yet where it is going to be going. Wait for the delivery, wait for the breakout, wait for high resistance to be put in, wait for low resistance to be able to be targeted, wait for the market to show intent of where it is going. That is going to be very crucial. So once again, another chore, not chore, but homework. Go find out where consolidation ranges are, mark them out with the rectangle box, see the delivery out of that area, and then see how market moves from there, okay? So that is it for that. We actually only have one more concept to go over. So let's go to that real quick, and then we'll be wrapping up the video. Okay, last concept we're going to be going into is exhaustion candles. It is a candle showing loss of momentum at a level, a long wick with rejection in a shrinking range, basically meaning that usually in most cases, the body of the candle is going to be smaller than the wick that is left. So an exhaustion candle is basically another confluence that we can add to our trading portfolio of showing, hey, we reached this level and now it is showing weakness. We are not continuing to hold that level. We are shrinking from that area. We are showing exhaustion from that level. So in this example, we're going to show a few of them. So exhaustion candles are also only used in a liquidity sweep or a fair value gap. If those two are not present, exhaustion candles are useless, okay? So we tap into this fair value gap, and what we see here is a very small body compared to this massive wick. What that means is that buyers were trying to take some control here, and they were so overwhelmingly out-auctioned at this level of this fair value gap. So what we can expect is this exhaustion is going to have us have a very flush move opposing from this direction. Now, what do we have with this high here is a intermediate high, okay? The first high left inside the fair value gap. When we revisit that high, we see another exhaustion candle, okay? A very large wick compared to the size of the body, okay? We actually have two large wicks here showing rejection and exhaustion from that level that buyers are trying to push it higher. Sellers are like, heck no, I got way more money than you right now. We're going lower. That's basically what it's saying. And then from there, we can see that price has a very sharp sell-off eventually. But very strong confluence and way to use basically candle theory of showing order flow without having an order flow chart. Once again here, we see a lot of large wicks compared to the size of the body at a liquidity sweep. That is an exhaustion candle, showing that in this case, sellers are about to take some freaking control, okay? Let's try to find some bullish examples here. Okay, so this is more of a high time frame example of it, but you see all of these wicks right here. Okay, this is more of a higher time frame play. This is the example of a more higher time frame market structure that's about to shift. But you see all of these wicks, all these exhaustion wicks, all these rejections from this level. What can that tell us? There's a big bid and auction going on at this level, and buyers are most likely going to end up on top of it. And that's what ended up happening. Exhaustion candles are very, very, very powerful and important. Okay, what we see here is we have this first fair value gap that was left here. When we tap that, we see a very large wick. The body is still larger too, but we still see exhaustion. We show a massive amount of rejection from this area. Okay, what is another, man, I'm having a hard time finding some downside examples of this here. Okay. Let's see. Bear with me all. Okay, perfect. So we have this intermediate low. What is an intermediate low? It's a first low left inside of fair value gap. When price reaches that, we see a massive rejection. The wick is way larger than the body in this situation. We see another rejection here, technically. This is an exhaustion candle showing that buyers are stepping in here. They are going to be sending the market higher. And then what are we backed with after that is a inversion fair value gap. Okay. All these things start piecing together to show where market is going to be going. Okay. Let's try to find a few more little examples here before we call it. Okay. Once again, we see all of these wicks at this level. Okay. We're continuing over and over again to push past this level. Okay. What that could mean is that there is a higher time frame structure shift that is about to happen. Okay. So what happens here? We tap into this fair value gap. We get a very, very large wick and a strong closing candle in the direction of the wick rejection. Boom. Take that trade. 9 times out of 10, you're taking that trade. That is showing exhaustion and intent within a fair value gap. Okay. Don't overcomplicate it. Okay. Once again, right here, we get a sweep of the first high that was left inside of this fair value gap. Remember, size doesn't matter with fair value gaps. We see a massive wick compared to the body. Rejection showing exhaustion means sellers are stepping in. You get another one right here. Boom. Okay. You got all of these levels over here that are showing exhaustion as well. Okay. So exhaustion candles are just another way to be like, okay, this is adding to the strength of this position. So I'm going to give you all a quick example of how I use it from day to day. If we tap into a fair value gap that I'm wanting to see price continue from, I want to see that level to get reached. And then I want to see a rejection candle or exhaustion candle out of that. I want to see a large wick. I want to see exhaustion, tiredness of buyers or sellers, depending on the direction of my fair value gap. That is giving me confidence that I'm on the right side of money. Okay. So that is it for exhaustion candles. That is all of the confluences and ideas that we're going to be going over today. It has been a long video. I have no idea how long it's going to be when I put it all together, but make sure y'all watch this over and over and over again. I'm telling you, you cannot study this stuff enough. Go on your charts, especially as a full beginner. Start just marking all this stuff out over and over again. Sit on your computer for hours and get your eyes trained and accustomed to these things I'm talking about. I am going to help you guys get to where you want to be at trading, but you have to do your part. Okay? I'm dead serious. I'm calling you higher. You got to do your part. Sit your butt down and get to frickin' grinding. Study. Mark things out. Start seeing the development of price. Become one with price. Okay? This is not going to be handed to you. You got to be willing to do the work. I'm so serious. I know you can do it. I did it. I was a mess when I first started trading. Okay? Now I am married. I'm doing this as my full-time career. I am more mentally and emotionally stable I've ever been in my life. I'm putting the Lord first, and that's also why I am seeing so much fruit from this, is because I'm putting the Lord first. He is going to bless you if you put him first. You should spend time with the Lord way before you get on the charts. Okay? That's a whole nother story, though. But He will bless the fruits of your labor. So get your labor done. You know what I'm saying? Like, put in this in a biblical standard. Put your labor in. Put long hours in on this chart. Do what you have to do to be able to fully understand. Watch this 10 times over. Continue to take notes and apply it to the charts, and you will be successful. We have a lot more chapters coming, a lot more things to break down. So soak this up. Make sure you watch it as many times as you need to fully understand, especially before you go into the next chapter that will be coming out, because the next chapter will be a lot more in depth about how to use these concepts. So that is it for today. Thank you so much for watching. I really hope that you continue to watch the series, and thank you for entrusting me to be able to teach you what I know and to be able to help you on your trading journey. God bless. Get on your chart. Start practicing. Stay safe, y'all. Peace.